In this week's update, US institutional selling becomes obvious. A couple more months where inflation spooks the market, reasons to be bullish, and is now the time for gold. My name is Garry Davis. As always, this is general advice in this video, and please remember to like and subscribe to the video. Well, what an interesting week we've had with strength in the market, which caused, I'm sure, a number of people to question whether the selling was done and we were back into uptrend mode. But Thursday and Friday, after the US inflation data, certainly pricked that bubble, and the market went down again quite strongly. And there was a lot of very concerted selling, particularly on Friday. Very obvious that that institutions are selling. Now, Warren Buffett's famous for many great quips and lines. Here's another one: we should buy stocks like we buy socks, and that is when they're on sale. Now, it goes against the grain of human psychology, because when prices are falling, a number of things run through our mind. One is, well, how much further could the price fall? You know, we tend to buy into the media hype that gets very negative. And we also start to think, well, what's wrong with the companies? If the prices are falling, there must be something wrong. But in the majority of cases, there is nothing wrong. It's business as usual. It's just the price that a stock is selling at is being adjusted down. So one of the good things about a correction period or a cyclical bear market, if this ends up being what it is that we get to buy great businesses much cheaper. And whilst that's bleedingly obvious when you stop and think about it, it's so easy to get caught up in the middle of all the emotion of this and forget that as prices fall, opportunities just get better and better. And so, you know, you actually should be getting keener and keener, not more fearful about what's going on. I think the bounce is now done. We can never be absolutely certain about anything in the market, and you've always got to remain open-minded and just work with what the market is telling you. But it would appear now that the bounce is done. There is just so many boxes ticked in favour of further downside that that's where the probability is. And I know some people who comment on this video who obviously have a bias that they don't want the market to go down, but you've just got to smell the roses and look at the reality of what's going on. So I think it's fairly clear that the indices are highly likely to be resuming their downtrend. And look, that's a good thing, because we're getting an adjustment down in valuations that was long overdue, and it will set up some great buying opportunities. So what deserves to be overweight? Where are the really high probabilities that that prices are going to continue in a generally upwards direction for many years to come? And commodity stocks, I've been talking about this for several years now. We're in the right part of the cycle, and then overlaid on top of that is one of the biggest investment booms that we will probably ever see, and that's decarbonisation and all the consequences of that. And it's just becoming evident, particularly if you look at some of the actions in the material that's coming out of the major car manufacturers around the world, that this whole EV revolution is just proceeding at an ever-increasing rate, and that expectations about demand are just going to continually fall short. And so we're seeing across a number of different commodity areas, prices are already up, you know, many hundreds of percent on where they were even just a couple of years ago, but destined to go higher. Megatrend technology stocks, that's not going away. You know, technology and the tremendous advancement and disruption that's going on in technology, that's not going away anywhere. It's just prices are going down. They're readjusting down from a level of excess to something more reasonable. And so there'll be great opportunities in that area. And there's one thing you can be absolutely sure of, and that is that those megatrends in technology are going to continue. And then there are other stocks that are perhaps borderline in those sort of megatrend or commodity areas, but they still offer strong and highly probable growth. And it's the second part that's so important. You know, there's many stocks, thousands of stocks that offer the potential for very strong growth. But how many of them are just pie in the sky, and how many are highly probable, and they're the ones that we want. Now, there are multiple reasons to be bullish once we get through this corrective phase or cyclical bear market phase, if that's what it turns out to be. And this is more bigger picture, so this extends 6 months, 1 year, 2 years out. Globally, we're in a situation where, because of a number of reasons that go back in history, but also because of supply chain restrictions, there's going to have to be a significant inventory restocking process, because I think the lessons have been learnt that if you run your inventory down to just-in-time levels, that events are going to come along that are going to be incredibly disruptive. So I think in general, stocks across all sorts of industries, or companies across all sorts of industries, are going to be running with higher levels of inventory. And so that restocking is going to create an excess level of demand for a period of time. Secondly, central banks will ensure that we've got adequate liquidity for economic expansion. They haven't put in all these hard yards since 2008 to let that go. And governments don't want to have a financial collapse or, you know, an economic recession on their watch either. So despite the need for higher interest rates to deal with inflation, central banks are going to keep an appropriate level of liquidity going. It may be less than what we've seen in the last year or two, but I think it's still going to be adequate for that economic expansion. Next, US corporate cash flows and profit margins are actually at record levels. So, you know, that's something that's not getting a lot of airplay. A lot of the focus is always on, you know, bottom line earnings, which can be manipulated by accountants, or on top line revenue. But it's the actual cash flows that, you know, it's hard to fudge those, because that's the money that's going through the bank account. And those that situation with US corporates is actually in a pretty robust position. Next, history tells us that despite what the media would have you think, that the first couple of years of rate rising cycles tend to see stock indices go higher. You know, whether you agree with it or not, that's just the reality. That's what happens. And generally, it's because rates are rising because we've got economic expansion. And so, of course, with economic expansion, you're going to get a level of inflation. But before that inflation starts to get out of control, it's very, very good for corporate profits. And so indices will tend to go up on that basis. And finally, as I've been saying for some time now, we're seeing, I think, the worst of the inflation data, because the comparative numbers comparing with the same month in 2021 are looking really bad. But later in 2021, from sort of April, May onwards, those baseline numbers start to move up. Supply chain issues will probably start to moderate that have been feeding into inflation. We're seeing the government stimulus being wound back. That's also been feeding into inflation. So I think two things are going to happen. The mathematics is going to make inflation look more moderate, and probably inflation in absolute terms is probably going to moderate a degree as well. So it's quite possible that in just a couple of months, we're going to see a different rhetoric in the market about inflation, and therefore the need for aggressive interest rate rises. Now, that may or may not happen, but if it does, just be prepared, because I reckon that's going to be the catalyst for the market to turn around and start to surge back up again. So there are all the reasons to be bullish. There are risks, of course. Central bank policy error, just, you know, not making the appropriate steps, being too aggressive is one. And of course, geopolitics, we've got flashpoints all over the world at the moment. So that's the other one that makes it a bit unpredictable. But in general terms, you know, things are looking pretty solid. So let's jump in and look at some charts. We'll start with the S&P. So we had a sharp sell-off we had the obligatory bounce, which always happens, and it was a bit of up and down. We had strong moves on Tuesday and Wednesday in the US market, and then the CPI data came out, was worse than expectations, and that just reinforced the selling again. And it certainly looks like, not so much at the S&P, because that is such a broad based index that it can cover up a lot of things, but when you look at a lot of other indicators, as I'm about to, it really points to further downside that perhaps is not that obvious in the S&P at the moment. So if we look at the Nasdaq, so the Nasdaq is certainly underperforming the S&P. You can see it down here. The line is falling, and falling quite sharply. So growth stocks are certainly being dealt more harshly with than the rest of the market. If we the problem with the Nasdaq is that whilst it is falling, it is heavily influenced by the mega cap tech stocks. And so if we want to look at a more accurate representation of the Nasdaq, then an ETF like this can give it to you. So this is the cloud computing ETF, WCLD, that tracks that cloud computing index. So cloud computing being one part, but one significant part of the Nasdaq. And if you look at this ETF, you can see it's down 31%. So well and truly into bear market territory and looking a lot worse. And so that is more the reality of what's going on in the Nasdaq. Some nasty selling. If we look at mid caps, the situation is also quite stark compared to the S&P. If you look at the relativity of the price to the moving averages, it's significantly weaker, and that's the reality of the majority of the market. So to a degree, the S&P is being held up by the fact that some of the real mega cap stocks like Apple and Google, etc., are still up there, but it's not to say that they can't fall yet either. Let's look at the small caps. This is the Russell 2000, obviously a very broadly based index, but we've had this break of very key support. We've rallied back to test that breakdown and then started to fall away. And one of the things I did notice looking through a couple of hundred US charts over the weekend is the elevated volumes, particularly on Friday, to the downside. That was really quite starkly obvious at the individual stock level. Okay, let's now look at some of the important spread charts that give us better insight into where the money flows are going. This is consumer discretionary versus consumer staples. Strong downtrend. We had a little bit of a bounce. Consumer discretionary stocks got a little bit of love for a couple of days, but as you can see, turned over on Thursday and Friday. If we look at the large cap growth, Russell 1000 versus 1000 value, again a little blip, but very strongly again to the downside. So not much question there about where the money flows are going. This is small caps, not quite as emphatic because there's been so much selling in small caps already, but that is still clearly forming lower highs and lower lows. And this is the S&P index versus gold, and we're seeing that index turning over just a little bit because gold was actually quite strong on Friday, but more about that shortly. Now, if we look at the actual indices in America, just a quick snapshot of those. So this is the banking index, XLF. Still looking quite buoyant, still pretty close to its all-time highs. And I mean, a rising interest rate environment is good for banks, so no surprise there. This is XLK, so this is technology looking weaker, and you can see just how significant the selling was on Friday. XLY consumer discretionary in absolute terms. So we've broken down from the 200-day, rallied back to it, and then falling away again. And just pointing at the volume here on Friday, closed near its lows. This is pretty emphatic selling. Now this is retail XRT, which is also looking fairly sick. And on the other side of the coin in America, so if you want to put your money anywhere in America, then you've got to go with where the strength is. And this is XME, which is their metals and mining index that also includes steel and aluminium. But you can see that's in a very buoyant position, and we actually got a breakout on Friday night, probably thanks to the gold miners, and the volumes were up, and that looks extremely positive. So you want to be, if you're going long in the market, you want to be where the uptrends are, not where the downtrends are. So certainly the minerals and commodity space in America looks good. This is energy. I've certainly missed an opportunity here in energy. There's two things pushing the energy price. One is the fact that we've got gross underinvestment, and that's pushing the price up, as I've been talking about for months and months. But now we've got this situation with the Ukraine, which threatens to disrupt oil supply into Europe, and that's pushing the oil price up as well. So it's difficult to come into the energy sector. I guess I've been waiting for a more significant pullback. Once it became obvious to me that the underinvestment was one of the drivers of the oil price, I then waited for a pullback to somewhere near the bottom of the range. That was what I was waiting for, but it never occurred, as you can see with this index. We pulled back a little bit, but then it took off. And now we've got this Ukraine situation, which is adding to it. And, if that were to somehow be resolved, then the price of oil is going to come back quite sharply. So it's quite a tricky section of the market at this point in time. Just a couple of other important things I want to show you. This is the VIX index. We're looking at this over the last 6 months. We've been sitting somewhere between 15 and 20 for the majority of the time. We had a spike up in December. These don't necessarily show you the intraday spikes. Certainly the one in December got up a little bit higher than this. The one that we had in January got up to about 38 or 39. And just in the last day or two, we actually did peak out at 31 on the VIX on an intraday basis. But you can see the VIX index is certainly revealing the fear that is starting to come into the market. And the bottom in the market will happen when we get a real blow off in the VIX, and then start to turn back down again. So that's one of the indicators I'm watching very closely. Now the other key one, if we look at the 10-year yield, let's just get a bigger picture view of the 10-year yield and look at it over the last 3 years. So you can see we've definitely turned the corner in July, August of 2020, when interest rates were down around 0.5. Now we've just cracked above 2% on an intraday basis. So if we zero in a bit more on that and look at, let's say, the last month, you can see we did spike to just over 2%. So that's what's causing the sell-off in technology, because of the readjustment due to rising interest rates. So plenty of evidence that that the US market is almost certainly going lower from here. So it gave up 1.8% for the week. We had a little tricky little bounce in the middle there, but the CPI data just killed that, and Thursday and Friday were very negative. As I said, the moves in individual tech stocks were really quite robust. The candles were large. They closed on or near their lows. The volumes were elevated. This just has all the hallmarks of institutions accelerating their sell-off. They've been doing that for some time, but I sensed a real acceleration at the end of last week. And one of the things about institutions, once they change the direction of the ship, they don't get it done in a day or two. There's such vast sums of money that it takes weeks and months for them to make the adjustments in their holdings. So this isn't going to blow over in a day or two. The US dollar was up a little bit, 96.03. The 10-year yield I've talked about, and also the VIX ended up closing at 27.4. So we'll just take a quick look at the currencies. So there's the US dollar. We seem to be certainly holding above support now at 94.7. We've peaked out just recently at over 97. And we're still sitting close the week at 96. The Australian dollar is mirroring that to a degree, but the strength in iron ore has probably got the Australian dollar a little stronger than it otherwise would be. And so we finished the week at about 70.5 on the Australian dollar. If we look at our index, we actually gained 1.4% for the week, but of course, a significant sell-off in the US on Friday night, and that'll probably be reflected on Monday. But the commodity sector, as we'll see in Australia, the mining sector and the energy sectors are doing so well that it's certainly making our index more buoyant than it otherwise would be. But in my view, because of the commodity cycle that we're in, the quality mining stocks are going to shrug this off pretty quickly, and so there's still a lot of very attractive opportunities in the Australian market. So let's take a look at our market. We'll start with the ASX 200. So we managed to scramble back into the trading range on Wednesday and Thursday. Some selling certainly on Friday, so that was the follow-on from the US on the Thursday night. But I would expect we're probably going to break this support level again on Friday. But if you look at where the selling's actually concentrated, we had a couple of days of robust selling in materials, but equally last week a very, very strong bounce back in mining. If we look at healthcare, this is where a lot of the damage has been done to the Australian index. There's nothing wrong with the CSLs and the Cochlears and the ResMeds. This is just this multiple contraction. You know, CSL going back 6 or 12 months was trading on a PE of around 45 times. You know, fabulous company, one of the best companies in the world, but it was just too expensive. Institutions had been happy to pay that price for far too long, and now that adjustment process is playing out. There's the finance sector, so we're still just sitting around the 200 days. So finance not looking quite as buoyant as it does in the States, but not looking too bad. And of course, energy has done okay, but again, not as well as energy has in the States. So there's quite a difference there. Now, turning to silver and gold, there's silver. We did see a move higher on Friday night in precious metals, but you have to say that silver is just stuck in the middle of the range. So there's nothing particularly special about silver. This was gold on Friday night. We're up around $50 odd, I think, for the week. So that's on a daily basis. So that's quite strong. And if we look at it on a weekly, you can see that maybe this is starting to turn and go up. But look, I've been caught in this before, here and here. There's been so many false dawns in the precious metals sector that I'm just not trusting it at the moment, I'm afraid. There's just not sufficient evidence there for me. I would prefer to actually wait for the breakout. So gold up $51 for the week. Lengthy consolidations in anything tend to be followed by explosive moves. So gold is looking a little more interesting. I still don't trust it, and therefore I would be looking for the breakout. But if and when the breakout occurs, then it's likely to be pretty explosive. So, you know, don't lose sight of gold. I'm not recommending it, and I wouldn't do anything until it actually does break out. But But if it does, the move could be very sharp. So maybe this time. Precious metals, GDXJ. The one thing that occurs to me here is that this has been consolidating in the bottom of the range, not the top of the range. So, you know, it's hardly a robust setup, and I'll just show you what I mean by that. So we'll look at GDXJ. So we've got this range here, recent range between 37 and let's say 48. And all the consolidation has occurred between 37 and 42. So it's all been occurring in the bottom of the range. Now, yes, it was quite a nice move on Friday night. And you can see bigger volume. But I just need to see more follow through on this before I jump back on the gold bandwagon again. For me in Australia, the target stocks, and I do own a couple of gold miners. One I've had for quite some time, and one that which is so excruciatingly cheap in my view, but the price doesn't seem to want to move. And the other one I've acquired just recently, which is a very exciting project that doesn't need a higher gold price for the share price to go up significantly. So in terms of gold, I'm not buying anything that requires the gold price to move up. I'm buying a project that's going to get the share price moving even if gold doesn't. And that's probably the only way that I'm going to own gold stocks at the moment. Turning to other commodities, copper was as good as steady at 445, but nickel is shot right back up again now. We're up to 1071, and we've got near record low inventories in nickel. That's what's driving it. The crude oil price ended up almost at 94. It's gone a long way very quickly. And obviously the threat to Russian oil supply is part of that. There's the spot copper chart, not a lot of change. The nickel chart had a good week, but this is the key one. The nickel inventories, you can see, really plummeted over the last year. We've dropped from 260,000 tonnes to just over 80,000 tonnes, and that's not much. That's not more than a handful of days or a week or so of inventory. So that is what's driving the nickel price. So wrapping things up, cyclical bear markets end when not so much when you get to a level where the fundamentals become appealing again. It's really more about sentiment, and that's why cyclical bear markets tend to overshoot at the end, because it gets driven by sentiment, and that sentiment builds and builds, and people get more and more despairing, and eventually the bulk of them throw in the towel at the bottom, and or in a bit of a crescendo, and that proves to be the bottom. So cyclical bear markets end when they end, but it's when sentiment gets reset, it's when valuations get reset back to a lower level, and I guess nobody really knows what that lower level is going to be just yet. So it's just a matter of following the money flows, which is what I try to do in this video every Sunday, is to give you a perspective on the market that perhaps you're not getting through the mainstream media, by looking at where the money is flowing in the market, and not just looking at the overall indices. The final thought, I guess, would be, don't lose sight of what stocks will rise well before the bottom occurs. Now, whether that bottom occurs in the indices in April, May, June, whenever, there are stocks that are going to rise way before that, and there are some that are already in uptrend that are extremely appealing, and members will know which ones they are. Portfolio analysts last week, we looked at where the best opportunities were in Australia and America. Importantly, how to live with your psychology during a time when your account value might be leaping around a bit and disturbing your psychology. So there are certainly things that you can do to make that easier to live with. We also looked at cobalt, which is a component in electric vehicle batteries, and some of the opportunities there. So that's it for this week. There's more information on the website. There's my email address. And I'm sure it's going to be another fascinating week. I'll be back with you next Sunday. Cheers.